Franklin D. Roosevelt once said, "Real estate cannot be lost or stolen, nor can it be carried away. Purchased with common sense, paid for in full, and managed with reasonable care, it's about the safest investment in the world." And real estate is what we do. This is the Realtors Radio Network. There's no sense in overcomplicating real estate. And if you're a first-time home buyer, an investor, or a real estate agent, you're about to get useful, practical, and smart advice on every facet of real estate. Welcome to the Realtors Radio Network. Now your hosts, SantosGarcia, Marco Suarez, and DawnMcCullough.
Welcome to Realtors Radio Network. Today we have a great surprise guest. We kind of ran into each other last week and we hit it off. Nick Agharkar is a tax attorney, but also a wealth advisor.
Yep.
And which I thought was a great combination. As soon as I met you, I heard those two terms together. I'm like, wait a minute. This is an interesting person. We have to have a talk, and we have to record it.
Yeah.
And so today we have myself, we have DawnMcCullough, SantosGarcia, and we are the usual suspects, as they call us, because we're always the same three people. But we wanted to have you on because, I thought what a great conversation this would be for people to hear about, your professions, both of them. And how they relate to real estate, to how they relate to homeowners. And so we have a few questions for you. But first, how'd you get, what made you get into this line of work?
Yeah, so I initially spent the first half of my career as an attorney as a litigator. So I was in court all the time, right? And I was cleaning up other people's messes.
Here in Jersey?
Here in Jersey,
okay.
Actually. And I actually built and then sold my own law firm. And after I did that, I realized I actually like business better than legal, right? I hated being in court. It got to be way too much of a grind. So I was actually talking to a buddy of mine who is in management consulting, and I was like, you know what? Maybe I'm going to go back. I'll get my MBA. I'll just change careers entirely. And he said, no, don't go do that. Come work with us as a management consultant. You get dropped into these Fortune 50 companies. You solve their problems. It's just like going to get your MBA, but we pay you. So I was like, all right.
Sign me up. Hold on. Where do we go?
It sounds a little better. Right? So I did that for about 3 years. But what was interesting there was, I would sit with my clients and I would talk to them about work and strategy and whatnot. But almost every single one of them, after we were done with that conversation, would turn to me and say, but you're still a lawyer, right? Because I have this property upstate, or, how come I'm getting taxed on these options? What's going on with my estate plan? That's when the light bulb went off for me. That if these high-powered executives are having trouble finding good advice, because they have to have advisors, so why are they asking me? Well, so there's a gap in the market. So I went back out on my own. I started my own law firm. I then added my Series 65 and found a home at Shorehaven Wealth Partners, a registered independent advisory house. And we're four guys managing about $500 million. So it's a nice it's a smaller shop. I know that sounds like crazy, right? Yeah, but it's from the perspective of the financial services industry, right? It's still very much a boutique shop. I have my own law firm that sort of sits next to it, and the sort of the model is to give a 360-degree view of someone's financial life. So there isn't a time that my clients can't pick up the phone and get some guidance from me, whether it's from a tax planning perspective, again from real estate, like what we're here to talk about today, right? Investing, their estate plan, how to organize your financial life. Because, listen, it's a heavy lift, and for most people, it's dead boring. So they don't want to do it, right? You put it off. No one wants to eat their vegetables. I tell people, really, I'm a produce, right? I sell vegetables, right? You got to eat your vegetables to make it work, right? And so that's what we're doing now, and it's really rewarding because what I'm able to do is really, I look at it as educate. I educate my clients so that they're empowered, so they're not really afraid of these things, right? The tax code is huge. People get worried about making a mistake because they could go to jail, right? Sure. That's serious. But at the same time, it's not like these things are so esoteric or so unbelievably complicated that no one can understand them. Mm-hmm. So with a little bit of time and a little bit of effort, really anyone can really learn how to do this stuff. So I look at my role as an educator and someone that can empower you so that you can make your own decisions. I try not to just tell my clients what to do. Instead, I try and sort of co-create the scenario that they want based on what I'm hearing from them, and I give them the tools to make that decision, and they just feel a lot more comfortable that way as well. So, yeah, that's a little bit about what I do and how I got here.
Nice.
Yeah.
And where is, you mentioned your law firm, where is it?
So my law firm is in Wyckoff, where I live in New Jersey here in Bergen County, and then the Registered Independent Advisory House is down in Red Bank in Monmouth County. So, but really, I'm everywhere. Since COVID, I don't know that the borders of our states matter anymore, right? I mean, we all have Zoom. Everyone's able to meet in anywhere. So I'm able to service clients really anywhere because, again, from the IRS perspective at that federal level, since I'm barred in one state, I'm able to represent people there. Sure. And then here in New Jersey, absolutely, if we have real estate issues or anything, I can also represent people here. I'm also barred in California and New York, so it helps. I've got quite a bit of a presence.
Right. Wow.
Yeah.
That's a big territory.
Yeah.
Well, I feel like we have so many questions for you. This could be a
long
very multiple part series.
Right.
But maybe we'll start a little bit more on the real estate side for us. So one thing that comes up a lot that seems to be so misunderstood, and I'm not sure why, but the whole capital gains thing. So let's talk primary residence, capital gains. Somebody bought their house, in the 70s or 80s, let's say, and you want to use some numbers, for example? We'll say?
Yeah, and so you know what? Let's even back up a bit and just talk about the tax code from a macro perspective, right? What the tax code is it's a manual of incentives. The government has given us incentives to do certain things. One of those things is sell your primary residence, right? We want people to buy starter homes, right? We want them to buy that small house and then move up.
Sure.
But how can you move up if you're going to face a capital gains bill off of your starter home, right? In the 80s, maybe that starter home was $15,000, right? Small little starter home. Now you live in it for 10 years. Well, shoot, by the end of the 80s, maybe that thing is worth $150,000. Boy, that's a huge appreciation, right? That's $140,000 plus worth of appreciation in that house. So if I have to pay 15 or 20% in taxes, I'm not going to move. That would freeze the real estate market, right? So the incentive is, hey, you know what? Your first $250,000 of gains, free of charge. That's what the government's saying, right? And if you're married, they're saying the first $500,000 in gains, free of charge, because we want you to move. We want the market to have some of that liquidity so that people can trade and trade up. That's more important, right? So the incentive here is for you to trade up. So I think when people have this misconception of what they're going to pay on the capital gains, it's a misunderstanding of what the government's trying to actually achieve here. Because the conception is the government just wants your money. They just want to take my money, right? They want to tax me in any which way that they can. What they're trying to do is incentivize you to do certain things and not do other things. So if there's a tax involved, if there's no loophole, something the government doesn't want you to do, right? But if there's a loophole there, if there's something that you can get an exception or an exemption, that's something the government wants you to do, right? So we should think about it in that way, right? So if you take a step back and think about what we're trying to do with the code here, what the government's trying to do, you get a better understanding of why. Why am I allowed to sell my primary residence, and if I'm married, have a $500,000 exemption on that gain?
Sure. Makes sense. It makes sense to me.
Right.
For some reason, it's something that we get this question asked a whole lot. And I think there are some other layers to it too, right? Improvements that you've done to the home and things like that.
So in figuring out the gain, you're always going to take whatever you are selling it for and subtract out what we call your cost basis. Cost basis isn't just what you bought the property for, but it's also the improvements that you made, right? And we're seeing that across the board, right? Especially in our area, you'll see people buy, 1,400 square foot homes and nearly knock everything down but the chimney, right? And
for tax
purposes.
purposes.
For tax purposes, right? And then rebuild, right, a much nicer house, right? Well, shoot, you've just certainly really increased your cost basis, right? So now you've actually reduced that potential gain, like using real figures, right? If you buy this small house for $100,000, you put $400,000 into it. Well, now your cost base is actually $500,000, right? Which allows you then to sell it for that $1 million price point. And still, if you're married, see no capital gains tax.
Sure.
Yeah.
Good. So let me get on to another question that we have. And it's a question that I think, or something that's really important that a lot of realtors are not aware of and they don't inform their clients about. And I think it could be a shocker, but a non-residence tax, if you will. So we're talking about a seller who is not a resident of New Jersey selling a property in New Jersey, and then they hear at the last second about this 2% non-resident fee. So let's talk about that a little bit.
Well, so first of all, you're probably going to get it back, right? That's
Sure.
like the headline there is that more likely than not, you're going to get that money back.
So people think of it as this, they're being penalized for leaving New Jersey. Oh, this is a kiss New Jersey goodbye tax, which is, that may have made headlines for kind of saying that's what it is, but it's probably everything but that.
Absolutely. Again, look, the thing is that if you're an out-of-state resident and your only nexus to New Jersey is this piece of property, and now you're selling it, well, how do I come after you? As if I'm all right. So when we think about it from the government's perspective, if I'm the state of New Jersey and you no longer own any property here, you're not a resident here, how do I go get taxes from you? I have no reason to collect any more taxes from you, right? So I have to protect myself in the event that perhaps you didn't calculate your taxes correctly. You didn't have enough in escrow. You're short, and it's not really fair to stick that with the buyer of the property because that's your responsibility. So what the state of New Jersey is saying is, listen, I'm going to hold this 2%, and when we settle up the tax year and everything's done, you're probably going to get this back. But in the event that you're short, I'm going to take this money because there's no other way. There's no other way for me to get this money from you. And again, if you think about it, as a New Jersey resident, I like that because that money is coming to my public services, right? In the roads and bridges that we all use, the schools, right? So it is, look, does it hurt? Sure, but it's short-term pain, right? And that money will come back. Now, the argument on the other side is it's dead money, right? I could have done something with that money. I could have invested it. I could have used that money in a useful way. Sure, but on the flip side, you're also selling an asset. And it was probably an investment property because you're no longer a resident.
Sure.
So are you really that bad off? So I think a little bit, too, is a little bit of just griping about, the cost of New Jersey. Look, it's expensive to live here. I also think it's one of the best states in the country to live in, right? I mean, our schools are amazing. The people are outstanding. The youth sports for me is great. I think it's a wonderful place to raise children and have a family. So, you pay a little extra, but what do you get?
And you don't have to wait half an hour for the ambulance to show up or the police.
Or an hour for a pizza, right? I mean, swear to God, try and order a pizza in any other state. See how long it takes.
Listen, I've been in other states where I've seen emergencies happen. I'm not kidding. In the South, I've seen places where an emergency or true emergency happens, and the ambulance might take 45 minutes to an hour and a half. I even saw once a 2-hour wait for an ambulance.
Yeah.
Around here, they're sitting in every other block.
Yep.
Waiting for something to happen to take care of you.
There's a sense of urgency in the Northeast, right? That I think does not really exist in a lot of other parts
it's
of the country.
underappreciated.
Yeah, very much so.
Yeah. So just to kind of simplify that, would you say that we could look at it as more of an escrow, if you will, or a security account? I was saying, hey, once you file your final New Jersey returns, if you don't owe us anything, you can have that money back.
It's a security deposit, right?
Or the balance of it, right? Maybe you do owe something, and then you get the balance back.
Exactly, right? And it might not consume that whole 2%.
Right.
Again, it's just like moving out of a rental house, right?
Sure.
Right.
They're going to hold on to your security deposit until we can make sure we can get in there, make sure I don't have to do any repairs, it's clean, it's all right.
Right.
Okay, well, then I'll give you your money back, right? I mean, we do it all the time, right? We all did it. So, again, I think it makes sense to think about it as like an escrow or a security deposit. Absolutely.
Good. Well, I think it's just this shock. Like I was recently on a listing appointment and I mentioned it to my client just so they're aware of it. I think any of us would be kind of shocked if we heard about it, as our attorney is going over the final figures. And they're like, oh, by the way, we're gonna hold back this 2%. What if I was taking all the net proceeds and going to buy another property, and now I'm 2% less.
Yeah.
So,
and I mean, it's the same thing with the millionaire's tax, right?
Sure,
I
the
find
mansion
that
tax,
a lot of people get, oh my God, oh no. And so I think it is important for realtors to preview that for people.
Absolutely.
That, listen, this is over $1 million. You have to pay a little bit more, right? So,
Sure.
Yeah.
So staying on the attorney side of stuff, I would ask, at what point would someone need a tax attorney?
I see.
That's a good question.
I think at all times, right? For me, tax season is every season. So I think a lot of accountants and a lot of people come to me and say, well, how come my accountant didn't give me this advice?
Yes.
CPAs are, I think, browbeat into do not practice law. Don't practice law. If you practice law, we're going to take your license.
That goes double for
That's for
realtors.
To realtors as well,
Yeah.
right?
Don't
No one should
practice law.
I agree. The unauthorized practice of law, you should not do it. Right? If you don't have a law license, don't
Right.
give legal
You are
advice.
not
Absolutely.
an officer of the court. Remember that.
You heard that's
Please.
100%. Do not give legal advice if you're not a lawyer. You will get in a lot of trouble.
Yeah.
But the thing is that I can give that advice, right?
Yes.
So the way that I work is basically I work with my clients year round. I have a team of bookkeepers. So I have a lot of small business owners, right? And real estate investors. So I have a team of bookkeepers. We do all of the books. I do the taxes. I do the tax filings. But throughout the year, I'm meeting with my clients sometimes once a month, maybe more, maybe only once a quarter. It depends on their business. But we're planning. We're always planning. The thing of it is that if you give your accountant just a stack of records at the end of the year or at the beginning of the year, right before tax season, they're just a historian. There's not a lot they can do or advise you as to, well, here's what you should have done. Well, but now it's too late, right? We need the documentation in place, contemporaneous with the transaction, right? So what I tell clients is before we make a move, let's paper it. Let's make sure all of the documentation is in place. If there's an audit or anyone has any questions, it's all on the up and up. Here's the file. Here's everything that we did. Here are all the moves we made. You have a problem with it? Too bad, so sad. It's absolutely in the code. You have nothing on me, right? The problem is that what gets people in trouble and what flags people for audits is they try and do all of that after the fact. So now they're trying to cajole or sort of contort themselves into the code section that allows them to do what they're wanting to do. But the CPA's hands are tied because they can't violate the law. They can't say like, oh, well, yeah, sure, I'll just write that down. You need to show them the documentation to prove up that you did it the way that you're saying you did it, right?
Most people work backwards. They're trying to finagle the numbers after the fact.
Exactly, right? Which is why I tell people tax season is all year round. It is not the year after.
Right.
The year after, it's too late.
It's too late.
What can I do but go back and say, well, I wish you would have come to me sooner. Which is why I only work with my clients on a year-round basis. I do not just take on clients just to do their tax returns. People ask, like, oh, hey, I heard you do tax returns. I was like, only for my year-long clients.
Right.
I'm not going to sit there and go back and forth with someone around why they can't take a deduction because they don't have the proper documentation. So, tax season is every season. Everyone needs a tax return.
Yeah. So we have questions from just a lot of different realtors that were asking, well, when should I work on my taxes? Should I, once a year? So that's the thing. Or, should I pay every quarter? What do you tell? Do you have a realtor clients?
I do. And so one of the things that I work with my realtor clients on is, first of all, you have to pay your estimated taxes. Do it
quarter.
religiously.
Sure.
April 15th, January 15th, and in the middle of the year, the end of the year. You've got to do them on the 15th of those months, right? So the other thing that I work with them on is actually setting up what I call a buffer account. We're all going to have great months. We're going to have months where, oh man, I closed 6 huge deals.
Please listen to this.
I am swimming
I
in
say
it.
this to people
right?
all the time.
Let me go get that Panamera. I'm going to go buy that house in Franklin Lakes I've been looking at, right? This is a terrible idea because the next month, nothing closed.
Right.
I'm sorry, I don't know if I can swear.
Yes.
But nothing sold. Now what?
Yeah.
Well, you got to take from your buffer account. What's the buffer account? It's the 30 to 40% of that money you took from that great month that you put away.
Right.
That you put away so that you can even out your income. That is the biggest piece that I work with my realtor and my salespeople clients on.
Right.
Is you've got to figure out a way to even out that income.
See
right?
all your realtors? I didn't tell him to say that. He said that on his own. Same advice, different person.
It will absolutely save you headaches, right? I can't tell you how many clients have come to me that have been like, man, I don't know. I just got behind because I had a couple of bad months. Now the IRS, they're after me for $10,000 plus the penalties plus the interest. Boy, it gets away from you fast. So you've got to set up accounts, and you've really got to think about it. I love the profit first model. Michael Markowitz, he's actually a New Jersey guy. So basically, what he advises, and what I advise my clients, and I sort of follow this as well, is set up different accounts for different purposes. Sure. So you have an operating account, you have your tax account, you have your buffer account. And actually, I advise people to put their buffer account at a completely different bank. At a bank that you don't really
Maybe
open
like
up.
an online savings account.
Absolutely.
That you don't
I did not tell him to say any of this, by the way.
He paid him before that.
No, honestly, I'll just to peel back the curtain. Literally, Marcos and I met last week
Right.
at a networking event.
Well, I've been telling this to people for
it's-
years.
Yeah, so
Literally
when we're
years.
coaching agents or even kind of mentoring them, we talk about this, but I think it falls on deaf ears a little bit. Bit.
Because again, but that's every person who makes a lot of money is going to feel like that, right? Because they're gonna believe in themselves, and we want them to, right?
Yeah.
We don't want them to not believe in themselves, have confidence that they're going to do well. Of course, you should believe in it. You should also be practical. You
Right.
should also,
Right.
say, okay, look, I believe in myself. I know that I'm going to crush it, but I also know
Rainy
the
days.
reality of things,
Yeah.
right?
There are rainy days.
Some deals get to the freaking closing table
Yeah.
and don't close, right?
Mm-hmm.
So you can't count your chickens before they hatch. You've got a plan, right? You are great. You're going to do wonderful. Everyone's going to make a ton of money, but you have to be practical about how you're spending that money and what you're doing. So I tell my clients, keep that buffer account out of sight, out of mind. It's basically break in case of emergency for those months where, you know what, I'm short $2,000 for my monthly nut, so
Right.
I got to pull, right?
Right.
Now, the flip side of that is you got to keep track. So if you pull,
You
you got to put back, right? You've got to put back. You can't miss that step, right? Because again, that's going to keep you afloat. That's going to keep you going. Look, the biggest thing in sales that ruins people is a lack of income, right? But it's not because there isn't income. It's because
But it might be the lack of discipline as well.
That's
kind
what I was-
of
yep.
in conjunction with
100%.
Because I think, and we talk about this all the time in this industry, and I'm sure it's very true of a lot of industries where you're independent contractors, but the freedom is not really free. It comes with a very high cost because if you don't have the discipline, and one of them being sort of that tax envelope of, and we recommend this all the time, do a high yield online savings account, right? So it's reachable, but you can't just go to the ATM and take that money out.
Right.
And take a percentage of your, commission check and just put it aside for the taxes. Sure, at the end of the year or April or whatever it is, that account might look, not as fun, but that's what it's there for. And it hurts a whole lot less than people that I know that are still, on payment plans from 3 or 4 tax seasons ago. And that's
and listen, remember, those payment plans, the interest does not stop running.
No.
So it may stop the penalties, but you may never get off that payment plan, right?
Sure.
Because the interest rates are outrageous right now. So you've got to stay on top of this stuff, right? And again, it is that discipline, right? So I think you're right. It's the thing that kills salespeople isn't the lack of income; it's the lack of discipline, right? That for when you have those great months, you have to know, okay, look, here's how I'm going to spread this out. Now, look, am I, the Susie Orman that's telling you, you can't have that avocado toast? No, right? No, absolutely. You have to have some fun, right? Absolutely, you should enjoy yourself, but you should plan for it, right? So if you're going to get this big commission check, you got to look at it and say, okay, what can I do so that I can also have a little bit of fun, right?
Sure.
And look, if you want that Porsche, great. Set up a Porsche account. Right. That account is for the Porsche.
Save up for it.
Absolutely, right? And look, do you need all of it? No, we have pretty good loans, right? But you should not be putting the minimum down and then taking out a 7-year loan with 9% interest. Don't do that either, right? Mm-hmm. Be smart about it. But again, if you're having these kinds of troubles, and if you're like, I just don't know where, work with a professional. Work with someone who can advise you and give you the tools that you need, because a lot of what we're talking about is in general, right? Everyone has a different situation. There is no cookie cutter here. There's no approach that's a one-size-fits-all. Everyone's going to have a different family scenario, a different background with money, how they think about money, all of that stuff. So you kind of have to work with people where they are and what their goals are.
Absolutely.
Yeah. Now that we're talking about savings, what are your thoughts on investing in real estate with retirement funds? Pros and cons.
Yeah. So, I mean, look, the problem with that is, so for example, if you're wanting to use your 401k, the issue there is it's a 5-year loan and you have to pay it back with interest. So that doesn't sound like a great deal to me right now. Well, the way that I look at retirement funds, I'm a huge history nerd. So the way that retirement funds came about, the way that we got 401k was an insurance consultant in the 70s, believe it or not. So back in the 70s, right, there were nothing but defined benefit plans, nothing but pension plans. There was no such thing as 401ks, IRAs, right? So everyone got a pension. You work at a place 20, 30 years, they're going to pay you 80% of your salary, rest of your life, right? Now, to do those projections, to figure out how much money then do I need to put away today to pay for these employees for the rest of their lives at these target numbers, how much money do I need to put away in today's rates with today's inflation? Now, in 1974, inflation and interest rates were both out of control, right? It was an awful situation, right? I mean, I remember my dad telling me his first house, he bought it with a 21% interest rate. It was bananas, right?
But nobody was complaining about
exactly.
They were
no
just so
one was
happy
complaining
to
about
get
the house, right? I think they were just like, oh, wow, I can
I got a house.
80,000 for a house or 70,000.
Yeah, exactly.
So
right.
It's
a give and take, right?
Yeah,
I mean,
absolutely.
when rates are low, prices are going to be high. When rates are high, prices are going to be lower. But at any rate, look, so the companies looked at this and said, I can't fund this pension. I can't come up with this kind of money. So what did they do? They started these 401k plans, the IRAs, to shift the burden from the employer to the employee, right? Now, look, the thing is that this obviously has put us in a lot of burden. There are a lot of people that have no retirement savings at all, right? And that's a problem. But the flip side is you've now overstuffed those accounts, right? So you've put so much money away, you can't get it until you're 59 and a half without the penalty, and even then it's ordinary income, right? And I also tell people, I ask people this all the time, in the future, do you think taxes will be higher or lower?
Higher.
So we're deferring our tax bill
To
into a
higher.
place where you believe it will cost more than today. So what are we doing here, right? At some point, you got to go on the internet, find a compound interest calculator, say, here's how much I have in my IRA. If I assume a conservative interest rate, right, by the time that I retire, will I have enough? Probably, right? If you even have let's say $250,000 in an IRA and you have another 30 years of compounding, let's say 8%, you're probably going to end up with a little more than $3 million. Do you need more than that in an IRA? Start a taxable account. Start a taxable brokerage account. And the thing that I love doing with savings, instead of savings accounts, municipal bonds. Municipal bonds are one of my favorite instruments to invest in because they're triple net tax free. There's no state, local, or federal taxes. If you invest in New Jersey municipal bonds, you just get pure cash for free. There's no taxes on it. It's a fantastic vehicle, and it's a fantastic vehicle to save for taxes. I actually advise a lot of my clients to put a portion into municipal bonds for taxes at the end of the year because it's free money, right? You're basically it spits out 6-7%, right? So it's not like oh my gosh. But you put enough in there.
I think it kind of is. Oh my gosh! Considering that, we have clients that sell their houses, and they have a few $100,000, and I'm like, you really should talk to somebody and make some money on that money. And they're like, I'm just going to leave it in my checking. I'm going to leave it in my checking account.
Yeah, exactly.
I'm like, wow.
This is
Call Nick.
I mean, basically, right?
I think I need to pay you now.
Yeah, I mean, but this is true. I kid you not, we work with a lot of people. We sell their houses, and not to get into their finances, but I say, you really should do something with that money. Not even saying go buy another house, right? Maybe they're selling their primary and moving into their secondary. They have, a big chunk of change. Put it somewhere that's going to do, make some money for you.
Yeah, and for you. I mean, this is the big thing is that what people don't understand about banks and about savings accounts is that it's actually a raw deal for you. Because when you give a bank money, the way our banking system works is that now that money is on deposit with the bank. The bank can then go to the Federal Reserve and say, look how much money I have on deposit. You give me a loan, and I'm going to loan that money out to business people. The loans going out of the bank are at a higher interest rate than you are getting from the bank. So if you think about that delta, right? So if your savings account is giving you 6%, but the bank is loaning it 9%, the bank's making. The bank is making out on your money.
Right.
So for me...
Which is the case every time.
Every time. Yep. At every bank, right? Sure. So for me, I keep only what I need to keep in savings, right? So I have my 6-month emergency, like nuclear event, emergency fund in a savings account, right? And sometimes I might move it into a CD if the rates are nice. But other than that, all of my money is at work. And it should be, right? Because we should be thinking long term and think about, okay, how hard can my money work? Because otherwise, you're just working for your money all of the time. Make your money work for you.
Right. So I'm going to switch back to the tax side of things. I know that we've had a few realtors asking us the same. We took a quick poll of people, of agents asking us. We asked them to tell us, give us some questions that you'd like to hear answers to, and a good chunk of them were asking about deductions, like what should they be writing off, what should be, what should they be asking someone to take a look on their, when they prepare their taxes. And so that was the bulk of the questions were, what kind of deductions? What can I deduct from?
Yeah.
I said, we'll ask on camera.
Yeah. Well, so listen. So first, shameless plug. I'll be speaking at the Regional Bergen, the Bergen Regional Realtors at the place in Saddlebrook on July 23rd.
Awesome.
So come out, hear me talk all about this stuff, because I understand that you guys are soon going to be able to set up LLCs for yourself,
Sure.
right?
Yes.
And now this is great, right? Because the thing that I tell people all the time is that W-2 earners pay taxes first and expenses with whatever's left over. Business owners can reverse that. They can pay expenses first and taxes with whatever's left over. So this is an excellent opportunity for us to talk about, well, what are those expenses? And the expenses, deductions, we're saying the same thing, right? Mm-hmm. So expenses, business expenses, are those that are ordinary and necessary for your business. Ordinary means that it's what another realtor, any realtor, what's usual and custom in your industry, what they would spend on. And is it necessary? Does it further your business goals? Okay, so I'm going to go for a ski trip in Utah. Now, there just happens to also be a realtor convention in Utah that same weekend. Great. So now, you're right. Right. Oh, look at that, right? Your flights, your meals, your hotels, everyone is paid for, right?
Right.
This is an excellent opportunity for you then to think. You have to think about what you're going to do before you do it. Can I make this an ordinary and necessary business expense?
I also didn't tell him to say any of this, just so that for the people, we just came back from conference, from a national conference for United. And so this is all stuff that I've already got over. But
can we have our next conference in Hawaii? I'm just asking for
and
a
can
friend.
I get an invite?
But go ahead. I'm sorry.
No, I mean, listen. That's
it's just so funny.
That's the whole game, right?
Yeah.
Is that the more expenses that you can go through and say this is a business expense, and here's why, and that's the critical part, right? You have to develop that muscle of, okay, I need the documentation.
Right.
Why am I doing this? And again, I'm not supporting tax cheats. I'm not telling you to evade or do anything
but this
illegal.
is part of the tax code.
Absolutely.
You're just going by the code.
You are absolutely, this is going by the book, but there has to be some business purpose.
Sure.
Right? So again, even if you're flying out somewhere and you're going to go take a family vacation, do some real estate activity. There are realtor organizations in every place in this world, right?
Sure.
In this world.
Sure.
There are places you can speak. There are places that you can meet with other marketing people. You can get to know markets.
Absolutely.
You can even go as if you have your own sort of investing company, aside from just actually being a realtor, you're prospecting. You're looking at deals. Make an offer on something, right? Make it a business trip. The more that you can do that. And again, business travel is one of the biggest expenses that a lot of my clients overlook. Yeah.
Wow. So you touched upon a little bit on how realtors are soon going to be able to get paid through an LLC or anything like, something of that sort. Do you have any, I know it's probably not a one size fits all, but do you have any thoughts on, should it be an LLC that's, taxed as an S corp or anything like that? Do you have any thoughts on it?
For me, it's tough sometimes for folks who have uneven income to be taxed as an S corp, because the beauty of an S corp is the self-employment tax and payroll. The way it works is that if you're an LLC and you take a distribution, you don't only pay ordinary income tax, but you also pay the 15.3% self-employment tax. You guys remember that, and I'm dating myself a little bit, but that scene in Big when Tom Hanks gets his first check,
Sure.
and it's like, who's FICA?
Right.
Right? Exactly. That is.
Why are they getting a portion of my check?
Exactly, right? That is that 15.3%. Right now, look, the employer pays half, you pay the other. So the employer pays 7.65, you pay 7.65 if you're an employee. But now you're the employer and you're the business owner. So not only when you take that LLC distribution, you are paying that 15.3% plus your ordinary income tax rate. Now, when you're electing to tax as an S corporation, if you start payroll and you start paying yourself, well, that 15.3% is applied only to your salary. So if you pay yourself a $48,000 a year salary, right? Well, sure, you're paying a small amount of ordinary income, but now the 15.3 is only at that 48,000, and that distribution you take at the end of the quarter when you've made several deals. Now that's just ordinary income tax. So that's a massive. That can be a really massive tax savings. Mm-hmm. The thing is that you've got to pay yourself the $48,000 a year, right? Yeah. So if you don't have that, or if that income isn't really able to be projected, that can get sticky, right? Mm-hmm. So you got to be really careful and work with someone. If you're going to do an S corp election, work with someone to make sure that the numbers make sense and the numbers work out, right? Mm-hmm. Otherwise, look, we have to think about things like adding up more deductions, right? But one of the nice parts about S corporations as well, and really small businesses in general, you can set up your own retirement accounts, right? And as we were talking about earlier, retirement accounts were started, right, so that they shift the burden from the employer to the employee. But again, 401ks, whatever else, they do have to be sponsored by the employer, right? So what's in it for the employer? Why should I do this for my employees? Well, the code allows you as the employer to put away more than your employees. So there's a SEP IRA out there that, if you haven't heard about it, look it up, right? Small business owners can put away up to $69,000 a year, and even more if you're older, right? Mm-hmm. So that can be a huge tax savings for you. If you have, if you have $1 million year, that can make a huge dent in your taxable income. But again, gotta plan it out. You cannot be coming to someone March 15th
at the last second
saying, hey, look, I want to do all this stuff, right?
Right.
Yeah, exactly. Like, I can't do much for you at all. I can write things in a box and then tell you what your bill is. That's what I can do. Yeah.
Wow.
Right.
Well, that was actually that was more than I thought you were going to be able to say on that, and that was great. So we appreciate that one.
Yeah, absolutely.
I'm here taking notes.
He's going to have this one on repeat.
I'm not even asking questions. I'm just taking notes and just like looking at the time. So when I'm watching this again, I could just, okay, let me go back here. Like, oh my God.
These are you're dropping very great gems here.
Well, Absolutely. It's important, right? And again, because too many people pay far too much in tax. I actually just started working with a small business owner who 2 years ago, his effective tax rate was like 41%.
Wow.
And he didn't know any better. He thought that was normal. I told him, no business owner in their right mind thinks that 40% in a tax is okay. It's not okay. You got to do things differently. And we can. It's just, again, it takes some foresight. It takes some planning.
I think it's also probably true, with you, right, with tax planning and advising, and then just even in businesses in general, that you should rely on a professional, because I'm sure we're all into like the do-it-yourself phase. YouTube, I'm guilty of it. I think I could build a whole house from a 20-minute YouTube video.
Let me tell you, I tried to build a patio from a YouTube video. That did not go well. That did not go well.
It would probably be a great YouTube channel of all the people that are like DIY fails.
Well, it's not supposed to be a triangular patio.
Yeah, I mean, oh my goodness. The amount of dirt. I had no idea that digging a 6-inch deep hole would cause that much dirt. It was ridiculous.
But I think, relying on a professional or somebody that, let's put it this way, even as realtors, we don't know tax code. We're not reading through and knowing what's, something new out there that you can take advantage of or whatever else it is. So I think, similar to our business as well, what we tell people, rely on a professional.
Oh, absolutely. Look, I mean, you're seeing it in your industry, right? I mean, there are all these, I've seen, what was it? A couple of years ago, it was that purple sign. It was like this sell your own house, right? There was like a platform, right, that you could do it yourself, right? And I look at that, and I'm like, that's sort of very silly, right? Because so many sellers are emotionally invested in the house, right? Mm-hmm. Yep. They're going to have a very, very different idea about what their house should be worth versus what someone will actually pay for it, right? Absolutely. So, I mean, I think that's similar in my industry, right? Like, I've had had people come to me and be like, no, this is the way the tax code works. And I'm like, I told you that.
You're telling me.
You're absolutely incorrect. Like, that's not
Dr.
at all correct.
Google.
Exactly, right? Or, I was in ChatGPT and this is what it said, right? Like, again.
ChatGPT is gospel.
Yeah, I know, right? I mean, look.
Didn't you know that?
I tell people good luck, right? I mean, you can try it, right? And look, the thing of it is that, yes, the IRS is overwhelmed. Are they going to get audited? Only 1% of filings actually get audited. So will you get away with it? I mean, look, the numbers say probably, but do you want to really risk it?
Who wants to risk
exactly,
it? Right.
Do you want to sleep well at night or not sleep well at night? I think
right?
that's what it comes down to.
Absolutely. And I mean, Warren Buffett had his convention or whatever a couple weeks ago, and he even said, don't pay an advisor 1%, just put it in an S&P fund, right? And that's fine if you are 25 years old and have 50 years, right? Exactly, right? But otherwise, you need someone to give you actionable advice, like actually take you through these things.
Be a little bit aggressive if you don't have that much time.
Right.
On your hands.
And again, it's why I got into this business, right? Because I saw that people were just not getting actual actionable advice. They were getting mealy-mouth answers because no one sat with them to really understand, what are you trying to achieve here? What's your end game? And that's where I start with all of my clients. How does this end? You're not going to be doing this forever. So what comes next? Right. And they think, wow, no one's ever, why do I have to think about what's next? Because you can't do this forever. What's going to happen, right? I mean, I've sat with clients who've had businesses that they want to sell. They tell me, I want to be out of this in 2 years. And I say, okay, well, then what? Well, then I'm retired. Okay, then what?
Right.
What do you do?
That's your exit strategy.
Yep.
Just does life end there?
Yeah, I mean,
that's it.
There's this story I've heard. There was this guy, he sold his business for like $100 million, moved down to Florida. All he does is play golf, right? It's a golf club. He was on the team one day. Is his name Mark?
No.
You're talking about
he's on the tee, and a new person meets him. And he says, "Oh, well, so tell me, who were you when you were somebody?" Wow, that hurts, right? I mean, that hurts, right? I mean, like, shit, right? Like, gosh, I so
wow.
So what do you do? What are you doing with your time? What do you do afterwards, right? If there's nothing next, you're just going to hold on forever, right? You're going to be doing the same thing forever and ever.
Sure.
Let's make a plan for how does this end? Do you want to sell what you have? Do you want to pass it on to someone else? Do you just want to walk away? How does it end? And then let's work backwards from when that time is that you want this thing to end and how you want it to end. And let's make goals for every year, every quarter until then, so you get to where you want to go.
Right. But that's why you start golfing before you retire.
Absolutely.
So now you're good when you retire, right? Because if you just...
When you were somebody, it won't come into question. No, this is what I just golfed. I just had this business for a little.
On the side. It was on the side. Mostly I was golfing.
And then when somebody asks you that, you're like, what's your handicap again?
That's funny. Well, I have to ask, because we always ask people this question in our podcast. Do you have any crazy stories that you can share with us in regards to your business? Of course, we have to.
Well, no, you know what I'll do?
Change the name to protect the innocent.
So it's awesome being a tax attorney because I read so many court cases, right? And those are the crazy ones, right? So two that I'll tell you that I always talk to people about. There was this was in the 50s. There was an accountant who bought a yacht, and he joined a yacht club, and he put Form 1040 and a flag on the yacht, right? And deducted all of it. The yacht club membership, the yacht,
Wow.
the flag, everything.
You're just there in the IRS at that point.
Exactly. And he said, "Oh no, it's marketing. It's marketing." No way. The IRS was like, absolutely
Like,
not,
you don't
right?
work for us.
But think about it, right? You see these cyber trucks, you see these cars with these wraps, right? It's the same thing, right? They think, oh, look at this, $100,000 write-off.
Right.
Absolutely not.
No.
You can write off the cost of the wrap,
Right.
and the wrap itself. But everything else, that's your car,
That's your
man.
business.
I don't know what you're talking about, right?
Oh, my goodness.
And then the other one is a couple years ago. This was actually during the pandemic. The former CEO of Match.com, he's a New York resident, so he moved to Texas, right? He bought this big ranch in Texas, right? Huge ranch, right? And he has a staff, everything down there. He even has his dog down in Texas. But he would spend all of his time in New York, right? He still maintained a place in New York. He would be in New York all the time, right? But Texas has no state income tax. So he claimed Texas as his state of residency. The IRS said, "You're in New York all the time. Look, here you are on CNBC.
Right.
I'm in New York. You're in New York. What are you talking about? You're in New York." He said, my dog is in Texas.
Oh.
How could I leave my dog at a place that I don't live? And he won.
Wow.
So,
Wow.
look, there's some crazy stories out there, right? But again, comes back to our initial, we got to work with the professional. You got to know
Sure.
some of these crazy stories so you know
Wow.
where that line is. What can I do, right? But listen, now the precedent is set. If you have enough money and you can buy a staff and a
a
dog,
dog.
Yeah. There you
moving
go.
down to Florida. There you go.
So is there a certain number of days that distinguishes a primary versus a secondary residence?
It's 181 or something.
Correct. So it's 6 months in a day, right? So you got it. So if you want to establish residency in any state, you got to go down to Florida for 6 months and a day, and then that's your new home, right? That's your new tax home. And look, even in New York, it can get even through municipalities, right? So for example, you buy a house in Montauk. Montauk has its own sort of tax issues as well. So it can get that granular as to what town you're moving to. So again, if you're going to make these moves,
Talk to your professional.
talk to someone. You got to talk to someone before you make these moves because again, you can't know all of this stuff, right?
Sure.
And it's important. It's going to be important to you.
You have to talk to a professional for sure.
Yeah.
Just like the former CEO of ForSaleByOwner.com had to talk to a professional. He sold his house with a realtor.
No way. Are you
Yes,
kidding?
yeah.
I'm
No,
not kidding.
Hilarious.
That's documented.
Yeah, you can Google that.
Yeah. So at what point we're gonna let you go soon? I promise. We're
No,
not
I
gonna-
I have
this
nothing
is
the rest of the day,
This is a
please.
multi-part
Yeah,
series because
yeah.
we didn't even touch on the 1031 stuff.
Oh,
which is
no.
a
Well, we could go
It's a
into
whole
that.
episode right there.
Depreciation. I mean, we have so much.
That's
yeah,
a whole
there's
episode.
We might have to invite you back for that, but I wanted to just because a few more questions that people had were what was the other one about the at what point should they reach out to someone like you, a wealth advisor? Are they making $100,000? Are they making $200,000? We've had agents that have come here making $34,000 with their other previous companies, and they come here and they make $300,000, $400,000. We have 28-year-olds making upwards of that. So this is new money to them. Like they've never had this experience before. At what point should they reach out to you? At $100,000? At 75? At $300,000? So that something that makes sense for them.
before they go to Lamborghini dealer.
Believe me, I stopped them all.
Well, wait a minute. They don't even have the money yet when they make us come.
I mean, come on. Now, look. No, so the nice part about where I work and how I work is I have no minimums, right? So our investment house, it's posted. We do not have any minimums as to how much money you need to have. And that's because look, if you go to these big banks, you go to these Merrill Lynch's and JP Morgans of the world, right?
There's a minimum.
And yeah, well, beyond that, right? I've had business owners come to me. They're making $2-3 million a year, and they tell me, I don't make that much money. I just don't. Who hurt you? What are you talking? You don't make that much money. This is so much money. This is a lot of money, right? But to a Merrill, to a JP Morgan, to a Bank of America, you're a small fish, right? Unless you got $100 million, whatever. I don't really need to talk to you, right? Yeah. So the reason I'm doing this is to give that quality advice at all levels of income. And it is so important for that 28-year-old to start working with a professional now because they have 40, 50 years of earning potential left.
Right.
If they do it right, they could spend half of that time working and then the rest enjoying their life. Right. So if you start early enough, it's very possible you retire at 50. Wouldn't that be nice, right? Mm-hmm. So, I mean, look, my own personal goal is at 61. I don't want to have to work anymore because then at least I'll still be young enough to enjoy my life.
Sure.
For our retirement clients, we tell them you have the go-go years, the slow-go years, and the no-go years. Mm-hmm. Those go-go years are right after you retire. You want to take that trip, you want to go on that cruise, go now when you can still move around, when you still have energy, when you still have the ability. They worry. I want to spend so much money right away, and now I'm spending so much. In 10 years, you're not going to be able to do those things.
Right.
And it hurts to think about, right? No one likes to think about getting older and not really being able to move around, but that happens to all of us. And we all see it with our own parents, right? And it's sad to see, but it happens to all of us. So don't think about it as, I need to hoard this money for when I'm 80, because when you're 80, you're not actually spending that much money. And in fact, you would have done better if you would have enjoyed those, first 15, 20 years of retirement.
You see, Dad, you shouldn't be spending all this money. he's 80. He's still.
Yeah, I mean, that's the thing is that, look, we have an elderly population that has more money than they can ever spend.
Yeah.
But again, it's a combination of things, right? It's being born and raised during the Great Depression. It's, having in the 80s, all the crises that happened to them, right?
Sure.
So our personal experiences are going to inform that. But at the same time, seriously, they can't spend all of this money. They don't have enough time to.
Yeah.
Yeah.
Absolutely.
Wow. And I love that you say that you don't have minimums, because I think that people automatically just think of going to larger investment firms and things like that. And the minute they hear, well, our minimum is 250,000, 350,000, $1 million, whatever it is, they're so intimidated by that I think they feel like, well, I don't make enough, or I shouldn't even get a wealth advisor because I'm not going to make that much anyway. And that's not true.
Correct. Absolutely. Look, at all income levels, especially when we're talking about realtors or salespeople, you're going to make money. It's going to happen, right? Mm-hmm. One way or another, it's going to happen. I think it's short-sighted of those big banks to let these people go, because ultimately, if I can do well by you now, when you're 27, I have a 30-year client. Right. For me, from my perspective, fantastic, right?
Sure.
Because eventually that 28-year-old is going to be a 58-year-old with kids going to college. Right. And now, if I've done well with them for 30 years, I have a chance to maybe do well with their kids.
Right.
And that's the point, right? I mean, my backstory is my parents are immigrants from India. Family is very, very important to me. Mm. And building generational wealth is extremely important to me, because my dad came here with a suitcase and $8, because at the time it was 1972, right? We were talking about inflation. Mm-hmm. Immigrants were not allowed to bring more than $8 into this country, right?
Wow.
And he built everything from that. So,
wow.
look,
Imagine.
and
wow.
and I am so grateful, right? And so incredibly lucky to be in the position that I'm in. But everyone has that opportunity. Everyone in this country has that opportunity, and we should all be able to exercise on that opportunity.
Awesome. You're running for president?
Yeah. Never. No, I don't ever want to do that.
He's not that crazy.
No.
Wait, you had a question about 1031 exchanges.
Well, I think we need to leave that for another podcast.
I'm happy to come back.
Yes, please.
Happy to.
Yeah,
there's a lot of misinformation, misunderstanding. Believe it or not, I think I would say, in my opinion, there's just so much mixed information online, which I know a lot of people just go online.
Yeah.
I would love to start asking you that, but I think it's a whole other podcast, seriously, just because we have a lot of questions on 1031 exchange. But I'll ask you this on it. Do you feel like it's underused?
Yes. And I think that's because people don't do enough planning, right? With your investment properties, you've got to plan it out. The question I always ask people when they go bananas on depreciation on their investment property is, do you plan to sell this thing? And when, right? Because if you plan to sell it in 5 years, that depreciation recapture is going to hurt. Now, you're going to pay it one way or another, but if you don't take as much, maybe there's a way it doesn't hurt as bad, right, if you do sell it. Now, if you are going to depreciate something all the way down to zero, 1031 exchange out of it, right? Because then you at least defer the capital gains. Now, but then you say, well, wait, the basis, how do I rebuild it? Well, you just bought a new investment property. You're not going to put any money into it. You're not going to increase your basis at all in that new property. There are ways that we can do this, but to your point, it's complicated, right?
Sure.
It's everything I just said is extremely general, and there are nuances to everything I just said, right? So
there's a lot of layers.
There's a lot of layers to it, and but if you do it right, I tell people it's a way that you can pass on generational wealth, right? Because, and this is sort of a preview, if you keep doing this, you 1031 exchange until you pass away, your heirs get to step up in basis at the time of your death in that last property you own, right? Mm-hmm. So if that last property you own was valued at $5 million on the date of your death, your kids take with a basis of $5 million, right? And now you've just erased all of that deferred tax, right? So people always say like, oh, but you're deferring the tax. You're not eliminating it. If you hold until you pass away, you kind of are eliminating it, right? So, that it's a great way that you can start small and keep going. But again, has to be with the end in mind. If the end is to pass it on, then we can make a plan for that. If the end is to sell it, we can make a plan for that. If the end is to build a portfolio, let's plan for that. But again, it really depends on what are we trying to do here? Why are we getting into real estate investing in the first place? That's the first question that we have to answer so we can make a plan that makes sense.
Sure.
Perfect. Santos, you have any other questions?
I was going to ask a question, but I already So I was going to ask you if the listener could walk away with like only one piece of an information from this conversation, what would it be? But it's just like reach out to you.
Well, no,
Yes,
I mean,
exactly.
but here I'll couch that a little better, right? So not only reach out to me, but don't be upset or feel a certain way that you don't know this, right? That's the biggest thing that I give to people is don't be like, oh, I'm an idiot or I should know this. No, you shouldn't. No. Why? Don't be hard on yourself and give yourself some grace, right?
They're a specialist for a reason. There's a doctor that specializes in your feet. There's one on your heart, one on your brain.
Exactly.
Everybody's an expert at something. Let the expert at this do that for you.
Right, exactly, right? And again, that's the whole thing, right? Because again, even with the 1031 exchange, the information, sure, it's out there, right? Yes. But there's a lot of it. So how do I know what to look at? How do I know what's right? How do I know what's wrong? Right. Don't be afraid to ask because you feel stupid that you didn't understand what you were reading, right? That's the biggest problem, right? Is that it's not any intellectual thing. It's our emotions. Our emotions take over and say, I don't want to ask because then he's going to think I'm an idiot and I should really just continue to study and I'll figure it out. Don't do that, right? Drop that ego,
right,
and come on down.
Well, I tell people that I'm mentoring. The only stupid question is the one that you don't ask.
Yes,
Ooh, yes,
that's absolutely right.
So, Nick, where can someone reach you? Is there a phone number? Is there an email that we can?
Or a website?
Yeah, so you can go to crownpointtax.com. Crown is with an E at the end, so CRONE. crownpointtax.com or shorehavenwealthpartners.com. You can email me at nick@crownpointtax.com or nick@shorehavenwealth.com. It'll all be, I'm sure, here somewhere. But yeah, no, and I'm on LinkedIn. I'm going to actually start doing a LinkedIn Live weekly to answer tax questions, so you'll find me there.
Oh, okay.
Easy to find.
And July, I'll be at
the Bergen Realtors, at giving a talk on all of this so that you guys can get set up as LLCs.
Is it a 10-day event to get all the questions? How long is it?
I know, right? I might have to camp out there. Right?
We need more than 10 days.
I feel like this was just the appetizer. Or maybe the free bread was just right here.
I am happy to come back and talk about this stuff. As you can tell, I can talk about this stuff all day. So.
Awesome. Yeah. Nick, thank you for being here.
Thank you for having me.
Appreciate it.
Yeah.
And Santos.
Thank you so much for your time. This is Realtors Radio Network signing off.
Keep an ear out for the next episode of the Realtors Radio Network, where SantosGarcia, Marcos Suarez, and DawnMcCullough share their wealth of real estate knowledge. We hope you've enjoyed the show. Make sure to like, rate, review, and share. Find us on social media at Realtors Radio Network. See you next time on the Realtors Radio Network.